Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of understanding the SEC, history, responsibilities and its role in financial markets. Investor protection. The SEC exists to protect everyday investors, you, your family, and anyone putting their money into stocks, bonds, or mutual funds. How does it do this? By focusing on both prevention and education. On the prevention side, the SEC works to stop scams like Ponzi schemes and pyramid schemes before they cause widespread damage. It monitors suspicious activity and acts quickly to shut down fraudulent operations. But protection isn't just about stopping bad actors. It's also about empowering investors with knowledge. The SEC runs investor education programs aimed at teaching people how to spot red flags and make informed decisions. Their resources include webinars, tools, and materials that explain complex topics in simple terms. Think of these efforts like a safety net. They not only catch dishonest players, but also give investors the tools they need to avoid falling into traps in the first place. Regulation of securities offerings. Before companies can sell stocks, bonds, or other securities to the public, they must go through the SEC. This process ensures that investors are given accurate and honest information. The key requirement: companies must file registration statements that disclose important details about their financial health, business model, and possible risks. The SEC's Division of Corporation Finance reviews these filings to make sure they follow the law and meet strict transparency standards. This oversight helps prevent companies from overhyping their offerings or hiding risks. For example, if a startup exaggerates its profits to attract investors, the SEC can spot the inconsistencies and require corrections. In this way, the SEC helps investors make decisions based on facts rather than false promises. By enforcing these rules, the SEC helps foster trust in the markets. Investors know that the companies they're investing in were subject to thorough scrutiny, making them more likely to participate confidently in the financial system. The SEC's impact on financial markets. The Securities and Exchange Commission, SEC, is more than a regulator. It's a cornerstone of the U.S. financial markets. Its function isn't limited to overseeing the players. It actively shapes the way markets operate, fostering confidence and stability. By setting rules and holding offenders accountable, the SEC ensures that everyone plays by the same rules. Let's explore how its regulations and enforcement efforts influence trading practices and corporate transparency. Influence on market practices. The SEC's rules and regulations are not just suggestions. They set the tone for how markets function day to day. These guidelines impact everything, from how securities are traded to how investors access information. Encouraging fair trading. The SEC enforces strict regulations to prevent manipulative practices like insider trading and pump-and-dump schemes. Without these safeguards, markets would become unfair battlegrounds where only the well-connected thrive. Promoting market liquidity. By requiring transparency from companies and market participants, the SEC fosters a more predictable trading environment. Investors feel more comfortable participating in markets where they trust the data available to them. Deterring malpractices. The threat of SEC enforcement deters market players from engaging in unethical behavior. When violators are penalized, it sends a clear message: cheating is not worth the risk. The SEC acts like a referee in a sports game. Its involvement helps ensure the rules are followed, creating a level playing field. This builds trust, which is essential for markets to grow and attract investors. Corporate governance and disclosure standards. One of the SEC's most powerful tools is its ability to enforce corporate transparency. By requiring companies to disclose accurate and detailed information, it ensures investors can make informed decisions. Mandatory disclosures. Public companies must file quarterly and annual reports, like 10Qs and 10Ks, to update investors on their financial health. These reports include key metrics such as revenue, earnings, and risks. Without such disclosures, investors would be in the dark. Accountability for management. SEC rules require companies to provide insights into executive compensation, potential conflicts of interest, and major decisions affecting shareholders. This keeps corporate leaders accountable to the stakeholders they serve. Fostering investor trust. Reliable disclosure practices give investors confidence. Whether you're buying a single share or managing a portfolio, you rely on the SEC to enforce truthful reporting. By making transparency the bedrock of corporate governance, the SEC ensures that companies aren't just attractive to investors, but also ethically sound. Think of it as the headlights on a car. Without them, driving or investing becomes far riskier. The SEC's impact ripples through the financial system, shaping behaviors, improving market stability, and boosting trust. Whether through cracking down on insider trading or requiring companies to open their books, the SEC plays a crucial role in keeping markets honest and efficient. Recent developments and innovations. The SEC has always evolved to meet new challenges in financial markets. In the last several years, its efforts to adopt technology and address novel investment products have been a significant focus. These recent shifts highlight the agency's determination to keep pace with an increasingly complex landscape. Technological advances in regulation. The SEC is turning to technology to enhance its oversight capabilities. Why? Because traditional methods can't always keep up with modern markets fueled by high-frequency trading and complex data. Data analytics for enforcement. Advanced tools now analyze vast datasets to spot unusual trading patterns or possible fraud. This technology allows the SEC to detect wrongdoing faster and more efficiently than manual reviews. For instance, algorithms might flag suspicious trades within milliseconds, a feat impossible for human regulators alone. Automation in filings. Companies now submit financial disclosures electronically through systems like EDGAR, electronic data gathering, analysis and retrieval. The SEC uses AI tools to comb through these filings for inconsistencies or red flags. It's like having a magnifying glass that never misses a detail. Cybersecurity focus. As markets rely more on digital platforms, the SEC has made cybersecurity a top priority. It ensures brokerages and exchanges prepare for cyber attacks, protecting investors' financial data from breaches. By embracing technology, the SEC is better equipped to regulate today's fast-moving markets. Think of it as upgrading from a typewriter to a supercomputer. The transformation is making oversight smarter and quicker. Responses to emerging financial products. From cryptocurrencies to meme stocks, the SEC faces challenges that barely existed a decade ago. Its stance on these trends is shaping the future of investing. Cryptocurrencies and digital assets. The SEC's approach to cryptocurrencies is evolving but cautious. It views many digital assets as securities, meaning they should comply with traditional regulations. Platforms offering crypto trading are under scrutiny to ensure they follow rules meant to protect investors. Think of it like building guardrails for driving on a new highway. Safety comes first. Decentralized finance, DeFi. DeFi markets, which operate without intermediaries like banks, raise questions about regulation. The SEC is investigating how to apply existing laws to these platforms, ensuring they don't become hotbeds for fraud. It's a tricky balance, but the goal is clear. Innovation shouldn't come at the expense of trust. Meme stocks and retail trends. The surge in meme stocks, like GameStop, highlighted how social media influences markets. Retail investors coordinating online can cause massive price swings, sometimes detached from a company's fundamentals. The SEC is scrutinizing this movement to ensure fairness while respecting retail investors' rights to participate in markets. These efforts demonstrate the SEC's adaptability. Whether it's crypto or community-driven investing, the agency is working to maintain fair and transparent markets amid rapid change. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.